Hi, Matt McAleer, Director of Equity Trading, back live in the Sarasota trading room. Just after the close, we've been doing some refitting in the office, trying to get prepared for when we have the full team return from COVID-19, doing preparations for when they return from the COVID-19 restrictions. What's the market giving us here in July? Equity market, not too much to complain about. NASDAQ obviously going out at record highs on the back of King and Kong, Amazon and Apple. Good strength across the board. What was encouraging was the broadening of breadth. With all the headlines about technology, it would probably surprise you to understand that utilities were the top sector this month. So a little bit of a defensive feel there, probably driven by this drive down in rates. 10-year Treasury, what did it go out at 53 basis points today, closing in on 0.5%. 30-year Treasury, 1.19, 1.2. Real difficult income game there. So you're starting to see some demand pick up in some of these dividend replacement sectors and industries. So utilities had a very solid month. Some of the other staples solid, consumer cyclicals solid. Of course, technology was strong, but the breadth also showed up in small and mid cap this month. Still growth over value. Utilities couldn't do enough to bring value up. It was still a growth story this month, both in large, mid, and small, but encouraging that small and mid, the redheaded stepchild of the markets over the last decade, had a nice bid this month. In terms of what we're looking for going forward, I mentioned we're trying to see if some demand can start to flow into these dividend names. We look at the banks, whether we make an argument for their business strategy being in line with our current economy or not. It's awfully difficult to look past 3.25%, 3.5% dividend yields in a JP Morgan, in a Bank of America, dominant franchises. You don't have to pick up much on the capital gain side, on the share price side, to get to that reasonable 6, 7, 8% annual return versus the Treasury yields I just mentioned. Something to think about. Similar over on the pharmaceutical side, where we see Bristol Myers that we added a couple weeks back at a greater than 3% dividend yield. Talking about a dominant name, a dominant player in cancer research. If I can pick up 3 and 3.25 there, lean on that drug pipeline, lean on that research versus a 120 on a 30-year, very interesting. As I bring up the slide for international action in July, notice that breadth, very solid. Again, Asia's been dominant, especially on the emerging side. Demand, bam, bam, bam. Taiwan, China, South Korea. You get a shallow pullback, there's demand. Those are types of things we look for. Are pullbacks met with demand, and are they met with demand at a higher level, a higher price than previous pullbacks? That creates that higher low. Makes it a little bit easier to trade against that low. Europe, good solid 2/3 of July. This back week in July, a little bit of softness. To be expected. Germany's been very strong. Switzerland, very strong. The growth segment of Europe, very strong. Similar to the US. Growth names dominating value names. They may be just following the blueprint our market used post 08, 09, where that fiscal loosening, money, that capital flowed into the growth names versus the value names. Be very interesting to see if Latin America can continue this bounce back bid they've seen over the last 6 weeks. Very tough March, April, May. But Latin America's gotten a little bid here, led by Brazil. Keep in mind a very harsh pullback. In terms of interest rates, Be very interesting to see if demand continues. Where can this 10-year go to? Where can the 30-year go to? There's enough of a train of thought that that's signaling bad news. We can't make that decision. We can only trade what's in front of us on the equity side. I like to say we don't like to look too far beyond our headlights. Right now, when there is weakness, demand steps in. We'll be watching that very carefully over the next 4 weeks. Have a great weekend.
Hi, it's John Mousseau. It is Friday afternoon, July 31st, end of the month. We saw bond yields continue downward this week. The 10-year bond went from 0.59 to 0.53, the 30-year bond from 123 to 119. Continuation of what we saw last week, this grind down in yield as the pandemic has reaffected areas of Florida, Texas, California, and Arizona. This is clearly a reflection of that. Muni yields also down this week. When you look at something like the 10-year bond yield, which really moved from about 0.65 to 0.53 in the course of the month, pretty significant. You're taking away roughly 15% or all available yield. So from our viewpoint, it is even more negative real yields. So you think about a 10-year bond yield at a 0.53, but a trailing 12-month core inflation at 120, you are at negative real yields. Something to think about. And when you look at the year as a whole, we know that commodity prices are down. We know that oil prices are down about 27%. We look at this in the context of inflationary expectations, which are now lower than they were at the start of the year. We know that we will come out of this. We know that we will get some vaccines. We know there's more help from Congress coming. Now that everybody has moved into the extremely low inflation part of the boat, we're starting to get a little more defensive and maybe move into the other end of the boat, thinking that we could get some inflation next year, that the surprise is probably on the upside, not on the downside as you come out of the pandemic. We're going to look to Congress, see what they can come up with next week on an agreement. We know the Republican plan, gave money to state and local governments, including $10 billion alone for airports. We know that they have not been able to come to agreement with the Democrats on what the amount of unemployment assistance would be going forward. So all of these things are to be wrestled out. We do know that in terms of municipalities, they have been able to enjoy the low interest rates and have allowed themselves to refinance some of their higher interest debt. So that's a good thing. Anything that lowers the nut for municipalities to finance themselves, particularly as they're coming out of this, is a good thing. So we'll be watching the unemployment rates next week. We're looking for the initial jobs claims again. Hopefully that starts to come down, and hopefully Congress can come to an agreement. You put those two things together, and that should possibly help. Have a nice weekend.